Joe, welcome to the Bitcoin Source. Can we start things off by you introducing yourself to the audience and to the world?
Absolutely. Thanks so much for having me. I'm really excited to chat today. My name is Joe Consorti. I'm a markets researcher, formerly a University of Vermont student. I decided to graduate a year early, so that way I could begin working in Bitcoin. I've been studying markets for upwards of 5 years now. I took up an interest in Bitcoin my second to last year of college and fell down the rabbit hole and started folding it into my markets analysis. And really, since then, I haven't looked back. I take a pretty heavy focus on the money markets. Rates lead a lot of my thinking. Obviously, the regime we're in now is pretty good to be a rates analyst. You get to tell people what's wrong with all of this rates action, why is everything going parabolic, and what it all means for Bitcoin. So it's very, very interesting. I work at a markets research firm called the Bitcoin Layer with Nik Bahtia, the author of Layer Money, the book you could see right there over my shoulder. And essentially, we cover Bitcoin through a global macro lens. We do that through our Substack newsletter, as well as on our YouTube channel, which we publish both on very regularly. We have 5 pieces of content every single week, as well as a morning show that I do on markets and macro content. And that's essentially it. I spend a lot of my time analyzing markets and essentially disseminating all of the relevant information to viewers so they can best navigate the market cycle.
What you do in the space is so crucial and critical. And a lot of people, I feel like it's like I'm a writer by trade, right? So I write a lot of Bitcoin content and things of that nature. And I feel like the analysts, the guys that research the market, the curves, the risks, they kind of get like the colder end of the shoulder in this space unless you're really into trading heavy or investing. So, this conversation is going to be really fun to really unpack. So, Joe, the question that I usually ask people on the show, like one of the first questions I ask people is, the sources of your Bitcoin knowledge. So for example, were there any books, courses, conferences, or even people in the space that really inspired you, orange pilled you, and allowed you to become a better Bitcoiner? So could you kind of like break down some of those experiences or any books that you want to rattle off to the audience?
Most definitely. I love that question. I love it for a couple of reasons. The first reason is I was orange pilled by a buddy in college. His name's Tyler LaRoche. He works at Bitcoin Magazine now. Everyone should give him a follow. Very, very bright guy. And him and I were in a whole host of classes together. We got sent home for school, from school because of COVID. And that was over spring break, unfortunately. So freshman year, spring break, I had only taken an overnight back from school because I figured I'd be able to get all my stuff the next week. Because as far as my knowledge, it was spring break. I was going to Hampton Beach, New Hampshire, and living it up for the weekend, or for the week rather. And then COVID hit on a Tuesday, and they said, you can't come back to the dorms and get your stuff. So that was completely unbelievable. I left my computer up there, so I had to get a new computer. Thankfully, everything was on Google Drive. And essentially, I had, at that point, an extreme level of disdain for the people who had the ability to do this and have this sort of top-down overarching rule. And, Tyler, one of my buddies, the following year, not the following year, rather, but the later on that year, October, November timeframe, this is 2020, he had started sending me a few articles. The first one was The Bullish Case for Bitcoin by Vijay Boyapati, which I have in book form now on my shelf back there. I'd highly recommend everybody to read that. The Masters and Slaves of Money by Robert Breedlove. And that is also a must read, I think. I think both of those things folded my thinking in such a way that made me understand Bitcoin as sort of an absolute necessity in a way. And from there, I started folding it into my understanding of markets and, sort of beginning to understand it as debasement insurance. This absolutely scarce instrument that individuals, that companies, that sovereigns, they can all hold, in reserve on their balance sheet and their bank account. And it could protect them from this extreme credit expansion that we experience. Obviously extreme credit expansion from a central authority. For 14 plus years, we've had ZIRP, zero interest rate policy, globally. Some places it's been worse than others, but basically people have been able to borrow for nothing. And as a function of that, there is now this deep rooted misallocation of capital throughout the entire financial system. And every single person on the planet, their money has been debased. Whenever there is a crisis that comes around, the solution is immediately easing monetary policy, as opposed to allowing the free market to sort itself out, allowing inefficiencies to correct, allowing the least efficient aspects of the market to be pruned, and allowing free market solutions to bubble to the surface. Instead, we intervene. Ultimately the release valve is always the United States dollar. And so over the last 2 years, almost 2 years to the day, I've been folding Bitcoin into my thinking. And right around last year, I started actually actively tweeting my Bitcoin, my markets research, and it's gone extremely well. And so Tyler LaRoche from Bitcoin Magazine, as well as Dylan LeClaire, who also works at Bitcoin Magazine, have been pivotal in my thinking. And that obviously you've got your must reads. You're the Bitcoin Standard. You're the Price of Tomorrow, the Fiat Standard, Layered Money. All of those have been extremely critical into the way that I think. And in terms of macro knowledge as well, the other book that I have that has that's facing out principles for navigating big debt crisis, that is also pretty pivotal to my thinking. So every single book here that I have with the cover facing out, absolute must reads. I think especially Layered Money too. And I know Layered Money is an extremely popular book. I'd highly recommend anybody to go ahead and read it. Sailor Academy course, Econ 101. You actually get a free copy of the book at the very end in PDF format. So I'd highly recommend anybody to read it. It sort of analogizes a lot of monetary history and how Bitcoin is akin to a base layer money like U.S. Treasuries, like gold, and just sort of how it can monetize to get there. So those are sort of that's my introduction to Bitcoin. Those are the people who introduced me, and those are some of the books that I.
This kind of leads into my next question, which is, I remember you speaking about on a previous interview that the Fed will cause a recession, which most people in the know, most Bitcoiners could pretty much agree. And you see the runaway printing, you see the price of inflation increasing every day. It seems like they're changing the interest rate, at a whim. And my question to you, Joe, is that do you think it's still worth it to invest in Bitcoin during the bear market amidst rising inflation?
I'll break it down into sort of the macro environment and then whether or not I think it makes sense to be scaling into Bitcoin here. The short answer is yes. It makes sense to be scaling into Bitcoin. It has since June, since we started seeing this unwind. We're at an extremely healthy floor right now in terms of Bitcoin's price, and I'll explain why I believe that. So when it comes to the macro environment, obviously we have this extreme inflation, and I don't necessarily believe that the solution to unbelievably low interest rates is the most aggressive hiking regime we've ever witnessed on United States soil until something pops, whether it's risk markets, financial markets that causes inflation to come down, the housing market. Ultimately, what the Fed's trying to do is there's this perceived trade-off between unemployment and inflation. It's called the Phillips curve. But the Phillips curve, the only reason that it is a somewhat valid economic model is because of centrally planned interest rates. The only reason the labor market gets so tight that it has to be traded off with, in order to unwind extremely high inflation, you have to break the labor market. The only reason that that's true is because rates are artificially held at extremely artificially low levels. The economy is flooded with cheap debt, and then jobs are created based on the assumption that debt can continue to be rolled at that level. That is the reason that there's a trade-off between a tight labor market and high inflation. And that's what we're going through right now. And so if there weren't these artificially low interest rates that were flooding the economy with debt, getting people jobs under the supposition that the companies that hired them would be able to roll their debt at these really low levels, you wouldn't have this situation. But unfortunately, it's the situation that we find ourselves in now. What that means, the Fed is essentially trying to destroy demand in order to bring down inflation. They're doing this through, aggressively raising interest rates. They have interest rate monetary policy and quantitative easing. Those are sort of the only two things they have in their arsenal. With interest rate monetary policy, they control two rates: the federal funds rate, which is an interbank lending rate, and the discount rate, which is the rate at which people can park capital at the Fed for a determined rate, and also the reverse repurchase agreement rate. The reverse repo facility is essentially a treasury collateralized lending service that the Fed provides. Collateralized with treasuries, people can park their reserves at the Fed overnight and then get a rate of return. And so that's essentially how the Fed sets monetary policy. Through raising this rate, they're discouraging lending, they're sucking capital out of the market, they're slowing the rate of credit. And in doing so, other interest rates rise in sympathy. So you see bonds sell off, United States treasuries all across the curve, from your lowest maturity to your highest maturity, sell off in expectation of rising rates. And you also see it abroad, right? Not only with sovereign bonds, but also other central banks who have to tighten in sympathy with the Fed. Otherwise, their currencies get debased into infinity. And so essentially, there has to be sort of this coordinated dance of rates and of foreign exchange around the world. And the Fed leads that dance by raising their policy rate, and everything, it sort of lifts all ships. They all have to rise in tandem. And so that's what we're experiencing now. We're experiencing this extreme liquidity contraction, right? That's the environment we're in now. I feel because inflation is, of course, a rate of change, I feel at some point here, we've seen peak inflation. Core inflation is still a little bit stickier, but I tend to believe that that will fall as well. Granted, we may end up normalizing inflation, 3.5%, 4%, a little bit higher than 2%, but that's okay. These are structural changes. I do think inflation is decelerating. I do think financial markets turmoil abroad in Europe, they're experiencing dollar shortages over there right now, funding stress with bond yields that are rising even faster than over here. I think that will force the Fed's hand to probably pause its extremely aggressive rate hiking cycle, the most aggressive one since the 90s, sooner than they might like to. So right around the start of that four handle, 425, 450, 4.5%, that is, on the federal funds rate, that's likely when they'll have to pause. And they're also doing quantitative tightening. So what that means, they're allowing assets to mature off their balance sheet. And what this does is it removes reserves from banks, right? So basically what happens with QE is just an asset swap. So banks, the United States Treasury is buying treasuries from banks and injecting them with bank reserves. And then QT is just letting those treasuries roll off of the Fed's balance sheet, which also makes those bank reserves disappear. And so it discourages lending from banks, which also slows the rate of credit, right? And so all of this is in an effort to bring down spending, to bring down inflation. Now, what gets hit during times like these? Interest rate sensitive assets, right? And the most interest rate sensitive assets of all are risk assets. Assets that, like the NASDAQ, that are incumbent on low interest rates, tech companies, they borrow quite a lot. Those are interest rate sensitive firms. Bitcoin is extremely interest rate sensitive, right? It is traded by those big market players the same way that you'd trade the NASDAQ. So as a result, in times like these, where interest rates are rising through the roof, what sells off first? Well, Bitcoin is highly interest rate sensitive, right? It's high beta, right? So high beta to not just the market, but the NASDAQ. So, it's sort of a derivative of a tech stock almost. But it also has extremely low liquidity relative to the S&P 500, which is $34 trillion in size. Bitcoin is 400 billion, right? Or when it was 60,000, it was 800 billion, 1 trillion, right around there. So it's very small. It's a fraction of the size. And so during these liquidity contractions, money gets drawn from Bitcoin the same way it gets drawn from the S&P 500. But because of Bitcoin's extremely low liquidity profile, you see Bitcoin dump a whole lot more and a whole lot earlier than the S&P 500 and the NASDAQ, because since it's traded by these same big money market players, you see liquidity get drawn out from Bitcoin to a much more severe degree. And that's why you saw Bitcoin draw down 80%. Also, Bitcoin has much more leverage. Obviously, there are more exotic instruments that exist in the wider quote unquote crypto ecosystem. I say it with quotes because I'm not going to dignify it by saying it seriously, in the wider crypto ecosystem. And that contagion of these exotic instruments during liquidity downturns also hurts Bitcoin. Some people post Bitcoin as collateral for loans. They have to margin call their Bitcoin, yada, yada, yada. All this forced selling that occurs throughout the wider crypto ecosystem has impacted Bitcoin. So Bitcoin sort of led the NASDAQ in this huge sell-off as a result of rising rates. And it also led this extremely, large leverage unwind. And you saw Bitcoin draw down 80%, right? So it leads other risk assets in all of these regards. And we've seen Bitcoin draw down 75, 80% like we have in prior cycles. This 20K area has been held since June. Back in June, over at the Bitcoin layer on Substack, we wrote about how we feel this is a solid range for the bottom, right? We call this a bear market bottoming range for Bitcoin. Now, why do I say range? Why do I enunciate range? Why do I, say that this, say it in quotes, the bear market bottoming range? Well, the bottoming range doesn't necessarily mean bottoming price, right? So this range has been extremely well defended because of Bitcoin's really low liquidity profile, only $400 billion. A couple of key buyers and all of us in Confluence have been smash buying, right? And what matters more is the players who have extremely high amounts of liquidity on their books that can buy Bitcoin and defend this level. This level is seen as historically cheap. And every single time, we've tried to drop below it, the NASDAQ continues puking, the S&P 500 continues puking, Bitcoin is ranging, right? And so my general thesis since June has been, because this is viewed as a historically cheap level, and because this of Bitcoin's extremely low liquidity profile, even as the Fed continues contracting liquidity globally, and even as money gets sucked from virtually everything, this level can be defended on Bitcoin. And thus far, that thesis has held true. And so I feel this is a fantastic area to scale into Bitcoin. It does not preclude Bitcoin from a potential deflationary impulse in risk assets where the Fed over tightens, some sort of bank contagion occurs, money suddenly gets pulled from risk assets, sort of like we saw in 2020, in March 2020, when everything puked intraday and then rose in the month to come. I don't think we're going to see something like that. People's books are a lot healthier than they were in 2020. And also, I feel financial markets turmoil over in Europe is going to force the Fed's hand to be more easy with their monetary policy. And that will be supportive of risk assets. And I think that will occur before you see a dump, quote unquote, in risk assets. But even if and when that day comes, I feel Bitcoin will continue to be supported at this 19 to 22K level, like it has been for the last 3 months. So not financial advice, of course, but that's sort of how I'm tying my macro thinking into my thinking about Bitcoin as of right now.
Yeah, that was great. And there's so much to unpack there. There's a couple things, and it's like a couple segues too of some things you mentioned that I'll continue in the show. But one of the things that I really want to talk about is you mentioned parking capital. And I want to speak briefly about earning yield on the Lightning Network. So for a lot of people, the Lightning Network is still pretty new. Cash App just opened up layer 1, 2, and 3, which is incredible. So I think more people will realize the power of the Bitcoin Lightning Network. And I know that's your wheelhouse and kind of what you do a lot of at the Bitcoin layer. My question to you is, Joe, is what is a Lightning Network bank? And, the benefits of utilizing something like a network, Lightning Network bank, for example, across channels versus, using a traditional bank payment rail. So how would that be beneficial to people that are investing, trading, or actually just looking for open liquidity that might be flummoxed on, should I use Lightning or should I just go with the traditional rails that I've been using since the time of Memorial?
For sure. That's an awesome question. Yeah, I love that. I'm really happy that over at the Bitcoin layer, we've got a platform to talk about all the ideas that these developers are bringing to light. I'm not a developer by any means, but what I aim to do is fold in the concepts that these new technologies bring to the fore and fold them into traditional finance thinking so that people can more easily understand them. And when it comes to Lightning, there are a slew of very, very cool developments. Essentially, when we talk about earning a native yield, on the Lightning Network, you're earning an active yield, right? So yield is just your rate of return, right, divided by your price, right, divided by the amount of liquidity that you've put up. Let's say you got a Bitcoin in the Lightning Network and you're earning X amount of Satoshis. Essentially, those Satoshis divided by your amount of Bitcoin in the Lightning Network would be your yield, but it is an actively generated yield. The word yield is sort of like a potty mouth term over the last year because people have come to understand yield is just printed tokens. People park their money in, Aave or SushiSwap or any of these other dog shit, cryptocurrency yield farming schemes. Apologize for the language. Being from Boston is just part of the vernacular, right? And that they've come to understand yield is just tokens that are printed out of thin air. But yield actually is generated by providing a service that people want. It's providing economic value. And in the case of the Lightning Network, you're actually providing economic value. If you spin up a Lightning node and have several well-connected channels that are routing liquidity to and from, then you could earn a native yield on the Lightning Network. It is an earned yield. It is not an unearned yield that's printed out of thin air. You're providing a service that people want. Now, in the infant stages of the Lightning Network, it's relatively simple to do this. If you've got, you could spend time on YouTube, on the internet, developing expertise in this field, and then slowly but surely allocating capital to a node, spinning up a whole host of channels and really connecting them very well, and then getting efficient at routing liquidity and earning a yield from that. But when it comes to the maturation of the Lightning Network through time, I think this is going to evolve into something called Lightning banks. And I haven't coined this term. This is a term that's been thrown around quite a lot at several meetings, but my interpretation of the meaning, interpretation of Lightning Bank, is a large central entity, one node or several nodes that have several hundred or several thousand channels that are very, very well connected and help route liquidity very, very efficiently for the lowest possible price. I think as of right now, the individual has the ability to do that, but over time, as Lightning Network demand grows and the Lightning Network becomes more crowded, we're going to rely a lot on these central entities in order to process transactions. Now, the beautiful thing about this is unlike a route liquidity rather. And an example of this is River Financial. I talked about them on the What Bitcoin Did show with Peter McCormick, but they are one of the largest Lightning Network nodes. They have an extreme number of channels, and they're very, very efficient at routing liquidity. They are sort of the proto version, if you will, of what will eventually emerge as a full-blown type of financial institution, a bank that has a business model solely around Lightning Network routing channel liquidity. Now, the beautiful thing about doing this is that, you hear the word centralization and you go, oh no, that means censorship. But with the Lightning Network, there isn't necessarily an efficient way to do that. Sure, you could censor transactions, or you could, if you're one of these large central entities, you could censor transactions, or you could prevent, or you could charge unreasonably high base fees and fee rates to people who are trying to route liquidity. But guess what? The moment you do that, somebody else is going to say, okay, this is bunk, I've had enough. Who wants to donate to me so we can spin up a node? Let's fill it up with a whole bunch of liquidity and let's make it just as well connected as this other guy. And so any bad actor on the network, other people have the ability, because the network is so infantile, to come in and say, no, we don't tolerate that. Let's go, lower base fee and fee rate than this guy, and we're going to open it up to everybody. So because the network is in such an infantile stage, any bad actor can be completely negated by somebody else coming in and spinning up a similar node, but with lower base fees and fee rates. And so naturally, because this is a free market, unmanipulated, essentially the dynamic of new banks coming in, charging lower and lower fee rates and being more connected and offering, and eventually we are going to get extremely good payment processing, and we already do, but more sizable payment processing, ability to send 500, 1,000, maybe even at someday. I have no doubt in my mind that that'll be the case. Dollars via the Lightning Network, via Sats, through these extremely well-connected and intelligent entities. The reason this doesn't exist as prominently as it does now is because, again, the Lightning Network is so small, doesn't take a tremendous host of expertise, but as it gets more crowded, expertise is going to start filling the space and making those smaller operations less viable. But the beautiful thing about Lightning is that any bad actor who would want to come onto the network, if you're a bad actor, the only thing that you can do is provide a service that people want. That's it, right? You can't steal people's funds. The worst thing you could do is close up all your channels, and then all of it gets settled up on the main chain anyway. So if you're trying to steal money, you can't. The only way you can steal money is by coming onto the network, becoming a whale, getting a whole host of very, very well-connected channels, and then earning a native yield by providing a service that people want. So that's essentially what we have on Lightning Network right now, is the ability to earn an active yield. And then the last portion of what I was saying is how I think that will evolve through time. And I think, again, the first iteration of it, a proto version of a Lightning Bank is what you see today with River Financial.
Yeah, that's so freaking profound. I think that that's so ahead of the game. Like, so many people, I mean, when you look at the Lightning Network right now in its quote unquote infancy, it's like, we use it peer to peer. I'll send you some money via Cash App really quickly. You get it in under 10 minutes. But what you're explaining, Joe, is like there's going to be possibly companies that utilize this business model, right? Where you have legitimate Lightning banks that have a series of channels that they've kind of, acquired over time, and it kind of helps people facilitate throughout the network to make channels faster and more efficient. And like you said, it's a stress test. As the Lightning network is used more, as it becomes more ubiquitous in the space, obviously scaling is going to make it faster, and you'll be able to, send larger transactions. And, this kind of leads into my next question, which is, you mentioned something in your conversation earlier about collateralized loans. And as we know, Michael Saylor caught some heat earlier this year for his kind of process of using MicroStrategy and collateralizing loans. But the people in the know understand that he did that for a reason, and there's like a game and a fulcrum that you utilize and leverage Bitcoin to kind of win. So my question to you is, Joe, do you think it's worth it to actually collateralize loans for Bitcoin versus just buying it straight out?
For sure. I think if you're if you want to use Bitcoin as collateral for a loan, I think you can. There are several platforms that allow you to do it now. And I think the key here for lenders and borrowers is over collateralization. Reason being, right now, when it comes to credit, everybody's extremely under collateralized. Like your loan to value ratio can be 150, 200, 300. When it comes to credit, that creates a lot of moral hazard because you may not even have the ability to pay back your loan, right? You can't even pay back your loan if you liquidated all your collateral because the loan to value ratio is so damn high. Loan is the value of the loan, and then the value is the value of the underlying collateral. So the higher the loan to value ratio is, the less of an ability your lender has to liquidate your collateral in the event of you not being able to pay it back. This is not good for borrowers because it creates cheap borrowing conditions. There are not a lot of, there's not a lot of skin in the game, no stakes whatsoever, versus over collateralized loans, right? Very low loan to value ratios where lenders have the ability to liquidate collateral immediately. And of course, if you do not have the ability to repay. This is important with Bitcoin because Bitcoin is extremely volatile, but it also introduces responsibility back to credit markets. I think moving into the future, credit is always going to exist. I tend to believe that in order to, people will always create something out of nothing when they can. But I think with Bitcoin, because it is so scarce, such a valuable resource, a scarce commodity in the eyes of not only the lender, but also the borrower, there's going to be a growing demand for over collateralized loans instead of under collateralized loans because nobody wants to get liquidated on a loan. The reason people will start taking out loans is to actually pursue projects, ventures, capital accrual that will yield a positive return on top of their loan versus why they borrow now and why I've borrowed and why other people I know have borrowed because it's extremely cheap. You could take out a 0% APR credit card when you're 21. Everyone and their mother sends them to every single credit card company, sends them to you in the mail. You could take them all out, 0% interest, $10,000 maximum credit, don't have to pay for 18 months. Are you serious? Are you kidding me? You're extending that line of credit to an 18-year-old? That's absurd. I think with over collateralized lending on top of Bitcoin, I think Bitcoin's nature as a scarce asset necessitates borrowers and lenders to want over collateralization. And I think that is going to introduce a new level of responsibility to the way we conduct business in the modern world. And I think it is going to completely reshape how we think of credit. So those are essentially my thoughts there.
Yeah, and you know what's crazy is like a lot of people are going to realize the value of Bitcoin if they do get liquidated because it's like the incentive is different, at least in my opinion. I mean, your credit score can be damaged in a traditional market, but it still gives you that chance to redeem yourself, even though it might take 7 years. But with Bitcoin, because it's so inelastic, it's so scarce, there's only a finite amount out there, it's not in your best interest to overextend yourself or get yourself into a loan that you know you can't pay back because once that Bitcoin is liquidated and goes back into the market, people are going to snatch that stuff up so quickly that if you understand Bitcoin and where this is going, you'd be best advised to really make wise financial decisions. And this is not financial advice on, taking that risk of taking out a loan, even though it's super cheap. I would say, a lot of people have gotten burnt, especially with the drawdown of the market lately, with the price going from 60 to 18 or 20. A lot of people didn't expect that or didn't have enough savvy in the market to understand where this curve is going and where it's changing. So thank you, Joe, for kind of breaking that down. I learned something today just from listening to you. And my last question for you, Joe, which is probably the best question of the show, is what is the best piece of advice that you would give someone that's looking to getting into researching and analyzing Bitcoin?
The best piece of advice that I would give you is to have an unwavering sense of curiosity. Unwavering curiosity, this immovable optimism for the future, just an unrelenting desire to learn, frankly. I think a lot of people might get caught up in the idea that things are too hard to understand, therefore why should I try? But I think if you're doing something that you really, really, really enjoy, if you put your mind to it, and if you believe you can put your mind to it and accomplish it, nothing can stop you, nothing can stand in your way. Before I did this, I ran 2 small painting businesses. The first one that I did, was $100,000 in size. The second one was $350,000 in size. I did this over the course of 2 summers. The reason I was able to achieve that is the same reason that I'm able to do what I am today and wake up and absolutely get after it. And that's because I have an internal locus of control, right? And I encourage everybody to have the same. It essentially means that no externality can stop you, right? If you have a vision and you take actionable steps to get there, nothing can stop you. You control the universe, essentially. It might sound cheesy, it might sound odd, but if you practice this, if you understand this, if you have this unwavering belief that you have a vision and you're going to put in the work to achieve it, nothing can stop you, right? You control all externalities. Nothing can get in your way. You can do it. So have an unwavering sense of curiosity. Constantly be finding people more intelligent than you to associate with. Always be the dumbest guy in the room, right? Always ask the questions that people think are stupid, right? Build out your understanding shamelessly. Be very, very humble, and good things will come, right? Put in the work, provide value, stay curious, and have fun.
Most definitely. I love that. That's so inspiring. And, in the words of Machiavelli, fortune favors the bold. So, you have to kind of be bold in this approach to Bitcoin and understand that we're so early in the space, and that the people that are in this space now, like myself and yourself, Joe, we're kind of the risk takers. We're being bold, and we're kind of putting ourselves out there to kind of learn about a digital asset that, in my opinion, is going to change the world. And we're so early, and we're like going to put ourselves in history almost for, being humble and trying to just be a student of the game and learning as much as we can, networking as much as we can, and just trying to make Bitcoin better for everybody. So, I think that answer was perfect. And I hope that the audience listening, anybody that's looking to do research or analysis in Bitcoin and they want to be inspired by Joe, take a look at this episode and really learn some of the gems that Joe has given us today. Joe, so lastly, once again, thank you for being on a Bitcoin Source, but give the world your social media handles and any future endeavors that you want people to know before we wrap this up.
Absolutely. Thanks so much for having me. It was a total blast. I'll definitely come on again. This was a really, really fun conversation I had. And you can find me on Twitter at Joe Consorti, the same way the name is spelled in the title. And you could also follow the Bitcoin Layer, thebitcoinlayer.com. There you will find our Substack page as well as our YouTube page. We're also available on all audio platforms. We're a premium markets research publication covering Bitcoin through a global macro lens. We're trying to fold traditional finance, fixed income, money markets in with this asset as well on its way to monetizing as a base layer reserve currency. So that's what we do. That's what I'm involved in. That's where I can be found.
Joe, thank you once again for being on the Bitcoin Source. I really appreciated having this Bitcoin conversation with you. Have a good one.
You too. Thanks.